Price to earnings ratio, or PE ratio, is a very common thing on Wall Street. You'll hear people speak about it often. The PE ratio is calculated by the price divided by the earnings per share of a company. It is typically used to compare values of companies. So if a company is trading at $100 and its EPS is $100, its PE ratio is 1 or 1 times. If another company is also trading at $100 but its earnings per share is $200, its PE ratio is 0.5 or 0.5 times. Therefore, you can say that the second company is cheaper than the first company. In other words, you have to pay less in price to get more or the same amount of EPS. This is something that many Wall Street analysts use as a first glance or a back of the envelope analysis of a stock. For instance, if I look at a stock, the first thing I'll do is I will look at actually its forward PE ratio, meaning what is it expected to be next year? And then what I'll do is I'll compare that PE ratio or that forward PE ratio to a group of stocks that are its competitors. Therefore, you can see if that stock is cheaper or richer than its competitors. If it's cheaper than its competitors, you have to look deeper into it because it might be a buying opportunity versus something that might be richer than its competitors or its peer group. That might be a stock that might be overvalued. That is a very typical way of analyzing stocks, and how most analysts get a first glance of any stock is through using that PE ratio.